The CEO of the world's most valuable chip company wasn't on the guest list. When the White House published the names of executives joining Trump's Beijing trip, Jensen Huang wasn't on it. Then Trump called him. Personally. Huang flew to Anchorage, Alaska, boarded Air Force One at the refueling stop, and landed in Beijing alongside Elon Musk. Think about what that one detail tells you. The head of NVIDIA, a company with a market cap larger than the entire German stock market, chased a plane to get into a room with Xi Jinping. 17 CEOs made that trip. Apple, Boeing, Goldman Sachs, BlackRock, Visa, MasterCard, Tesla. The companies that run the world's most important supply chains, financial networks, and technology stacks, all in Beijing this week. NVIDIA alone, the company whose CEO chased the plane, is currently worth more than twice the entire German stock market. If you own a tech stock, an S&P 500 index fund, or any emerging markets exposure, what happened in Beijing this week affects your portfolio. Not eventually. Now. And here's the thing. The deal headlines are not the story. By the end of this episode, you'll understand why 3 words she said are worth more to your portfolio than every deal number Trump announced. May 13th. Trump lands in Beijing, the first U.S. president to set foot in China in nearly a decade. 2 days earlier, before the plane even took off, the two sides had already cut tariffs from 145% to 30%. That pre-summit concession, staged deliberately before the cameras were rolling, tells you something important. Both sides needed a win badly enough to give one away before the negotiation started. 17 CEOs flew with him, and the headline deals followed. Trump announced China agreed to buy 200 Boeing jets. China committed to double-digit billions in U.S. agricultural purchases. The U.S. approved H-200 chip sales to 10 major Chinese technology firms: Alibaba, Tencent, ByteDance, JD.com. Trump called it fantastic. Xi called it historic. Markets reacted. Then Boeing fell 4% because analysts had expected 500 jets, not 200. That gap between the rhetoric and the reality is exactly where the real story lives. On the surface, 2 superpowers meeting as equals. Underneath, 2 sets of structural pressures that made this trip unavoidable. Washington's problem? The tariff experiment had hit its ceiling. 145% tariffs were designed to reshape supply chains. They partially worked. Apple moved assembly to India, Qualcomm began diversifying its OEM base. But the structural dependencies didn't disappear. China processes approximately 85 to 90% of the world's rare earth materials, close to 99% of heavy rare earths, the minerals inside every advanced chip, EV battery, and defense system. When Beijing restricted rare earth exports in retaliation for the chip ban, it was a precision strike at the foundation of U.S. industrial policy. The tariff wall that was supposed to reduce dependence on China had, instead, exposed exactly how deep that dependence goes. Beijing's problem: China's export recovery was real but fragile. The economy needed the certainty that only genuine tariff relief could provide. And Xi needed something he could point to, something that showed Chinese companies, the world's biggest U.S. tech firms, still wanted to be in China. Those 2 sets of pressure created the same exit ramp, and they took it. Here is the detail that almost nobody covering this story connected. The U.S. approved H-200 chip sales to Chinese companies. That part made every headline. Here is what didn't. Not a single delivery has been made. The U.S. Commerce Department gave the green light. The chips are ready. The quota is 75,000 units per approved customer. And Chinese firms, Alibaba, Tencent, ByteDance, pulled back. Not because they don't want the chips, because Beijing told them to wait. The U.S. lifted the ban. China is holding the order. Huang's presence at this summit signaled something larger than a single company's revenue problem. Semiconductor policy had crossed from regulatory and commercial terrain into presidential-level geopolitics, the same table where Taiwan, Iran, and rare earths were being decided. Think about what that means for money movement. When chip policy sits at the trade desk, it moves on export control filings and licensing decisions. When it sits at the presidential table, alongside the issues that reshape alliances and redraw supply chains, it moves on summits, frameworks, and the kind of decisions that take years to unwind. The velocity is different. The magnitude is different. And the signals you need to watch are completely different. That is the single most important reframe for NVIDIA investors from this trip. The chip revenue recovery is no longer a Washington decision. It is a Beijing decision, made at the highest level of the Chinese state. Now, here's what this means for where the money moves. Here's what most of the coverage got wrong this week. Everyone focused on the deal numbers, the 200 jets, the soybeans, the chip approval. Smart money isn't watching the numbers, it's watching the architecture. Because buried under the deal headlines, Xi introduced something that will govern every US-China investment decision for the next 3 years. He called it Constructive Strategic Stability. 3 words. And if you're an investor, those 3 words just changed your planning horizon in a way that no individual deal number could. Here's the thing most investors haven't connected yet. The single biggest weight on any China-exposed stock right now is not its earnings, not its revenue, not its balance sheet. It's the geopolitical risk premium, the discount the market applies because nobody knows whether the US-China relationship will rupture. That discount is invisible when things are stable. It becomes visible fast when things are not. Xi just put a 3-year floor on that discount. Constructive strategic stability. Cooperation as the mainstay. Moderate competition, not maximum pressure. Manageable differences, meaning Taiwan, tech restrictions, and financial frictions stay bounded rather than escalating. Promises of peace. That's not a press release. It's a named framework, with a 3-year duration that both presidents agreed to. And whoever names the framework controls its meaning. Beijing just got the naming rights to the most important bilateral relationship in the world. Now let's follow the money. Semiconductors. The most direct and most conditional repricing. NVIDIA's China revenue has collapsed from roughly 26% of total revenue in 2022 to approximately 5% by late 2025. The H200 approval could begin reversing that, but only when Chinese firms actually start taking delivery. Watch NVIDIA's earnings on May 20th. China revenue will not have recovered yet. That quarter ended before the summit. What you're listening for is Jensen Huang's guidance language. If he names a delivery timeline or quantifies a China pipeline, that is the market-moving signal. The real proof comes in the August earnings, the first quarter where H200 revenue could actually show up. Zero China revenue in August means Beijing's brake is still on, framework or no framework. Aerospace, the paperwork test. The 200-jet Boeing announcement moved markets. Then Boeing fell 4% because the street had priced 500. Here's the framework lens. A 3-year stability horizon makes a large aircraft order financeable for Chinese airlines in a way it wasn't under trade war conditions. The framework is the enabling condition. A signed purchase agreement with delivery schedules and financing is the investable event. Trump on Fox News is not. Financials, the slow burn that just got a timetable. BlackRock wants deeper access to Chinese capital markets. Visa wants a 100% owned payments joint venture, unprecedented in China. MasterCard wants a higher stake in its existing joint venture. None of these close fast. Chinese regulatory approvals move slowly, but the Constructive Strategic Stability framework provides the political environment that makes multi-year negotiations viable. Watch for PBOC licensing decisions in the second half of 2026 as the first test of whether financial market opening follows trade stabilization. And then there's the trade that just got harder to hold, the decoupling trade. Supply chain reshoring plays in Southeast Asia. Domestic U.S. chip fabs built on the assumption that China tariffs stay at maximum pressure. The framework doesn't eliminate competition, but it puts a 3-year ceiling on escalation. If you're holding positions built on a permanent rupture thesis, the architecture just shifted under you. Before the scenarios, one number that puts the stakes in context, MSCI China is currently trading at roughly 11.5 times forward earnings. U.S. equities are at approximately 21 times. That gap, nearly 10 points, is not a valuation story. It's a risk premium story. It's the market's answer to the question, how much should I discount these assets because the geopolitical situation could rupture at any time? Xi's framework just changed the answer to that question. Not to zero, but lower. Every point of certainty the Constructive Strategic Stability framework delivers compresses that gap. Every point of escalation widens it. The next 3 years are essentially a running vote on where that discount settles. 3 scenarios. They escalate. Scenario A. Framework holds. Managed stabilization. Probability 55%. Tariffs stay at 30%. H200 deliveries begin as Chinese firms take up their approved quotas following the post-summit signal from Beijing. The bilateral trade board convenes and produces incremental agreements. The September Xi visit to the U.S., invited by Trump on the flight home, yields regulatory concessions for financial firms. Competition continues. Blackwell chips stay restricted. Taiwan stays unresolved. But moderate competition and manageable differences hold. This is the most likely outcome, and the hardest one to make exceptional returns from, because it's also the most anticipated. The positioning into this scenario is already crowded. The investors who profit from Scenario A are those who were already in before Beijing this week. The signal, H200 delivery data in NVIDIA's August report. If Chinese revenue is recovering, Scenario A is playing out as expected. Scenario B. Framework deepens, genuine opening. Probability 15%. Blackwell chip restrictions ease in the second half of 2026. U.S. financial firms receive majority ownership in Chinese joint ventures. The September summit produces binding regulatory decisions, not just framework language. The strategic stability architecture transitions from managed coexistence toward active integration. This is the scenario most investors are hoping for, and pricing a small portion of probability into. The clearest single marker, a Blackwell export license approval. That would signal the technology boundary has shifted, not just the trade boundary. It would reprice semiconductor exposure sharply. The signal, any Commerce Department language referencing Blackwell in a licensing context. It hasn't appeared yet. Scenario C. Framework breaks. Probability 30%. Higher than it looks, because the framework's stability is explicitly conditional. And Xi made the condition visible. He agreed to the framework in the same breath as warning that mishandling Taiwan could put the relationship in, his words, great jeopardy. That pairing is structural, not rhetorical. Beijing now has a named architecture to point to if it wants to declare the U.S. the disruptor. A U.S. arms sale to Taiwan, a military exercise in the Straits, a Taiwanese political development. Any of these becomes, in Beijing's framing, a violation of constructive strategic stability, with the U.S. cast as the party that broke the agreed framework. Trump didn't answer the Taiwan arms sale question on the flight home. That non-answer is already Scenario C operating in slow motion. The signal, watch every U.S. government statement on Taiwan arms sales over the next 60 days. Watch whether Trump makes a determination. A leak alone tests the framework. The CEO caravan was the visible event. The framework is the structural change. Most investors will track the deals, the jet orders, the chip approvals, the agricultural commitments. Those are the noise. The signal is whether constructive strategic stability holds, deepens, or breaks. Everything else is downstream of that. 5 signals. Sequenced. May 20th. NVIDIA earnings. Listen to the guidance, not the revenue line. June through July. Rare earth shipment data. Physical flows, not press releases. This is the most undercovered signal from the entire trip. August. NVIDIA Q2 report. First quarter where H200 China revenue could show up. 0 means the break is still on. Recovery means the detente is real. Second half of 2026. PBOC licensing decisions on MasterCard, Visa, and BlackRock joint venture applications. September. Xi visits the U.S. That's where the framework either produces binding concessions or gets exposed as pageantry. China named the rules. Those 5 signals tell you whether the game is actually being played by them.